prices paid are picking up quite materially. So again, this is going to be a concern for the Federal Reserve. It's also a concern for financial markets. Welcome to Key Points for January, and also welcome to a new year that's already throwing us some political, geopolitical and market challenges. So I think we're going to have a lot to be discussing in the months ahead. Now this month we're focusing on US growth, the inflation prospects and the turbulence that we're seeing in the financial markets and where we go from here. Now let's start with the first point. US growth has been very robust. We've seen consumption and the GDP numbers for Q3 showing an economy growing well above trend. Now the chart I'm showing you here is looking at small business optimism. And you can see despite that much better than expected and above trend growth, actually small business optimism up until recently has been very subdued. And in fact, consumer confidence generally has been subdued, hence the reason we've got a new president coming into office in the weeks ahead. Now that new president is offering even more growth prospects. We're seeing the possibilities of further tax cuts. We're seeing lighter regulation, and small business managers are loving this. You can see this massive jump in small business optimism, just as there was back in 2016 during the first Trump term. Now, the real challenge is this going to lead to too much growth? We've already had growth, as I said, above trend. We're already struggling to get inflation back down to target. And the real risk now is that actually the economy could overheat. And we suspect actually we need to see slightly slower growth going forward than some of the potentially higher growth numbers that people are still hoping for. So turning to our second point, we are a bit concerned that inflation is proving more challenging, certainly than the Fed had hoped, given that better growth dynamic. The chart I'm showing you here, the red line is core PCE inflation, the Fed's favoured measure. And you can see, of course, that had come down dramatically from the post-COVID highs that we had seen. But you'll also see that recent months, it's begun to flatline a bit, with the last reading actually picked up to 2.4%, so significantly above the 2% Fed target. But what's quite interesting is the blue line, and this is the thing that I think we should be a little bit concerned about. This is looking at the ISM Services Prices Paid Index. Now, this is a diffusion index. Anything above 50 shows you expansion. And indeed, latest readings that have just come out shows that actually prices paid are picking up quite materially. So again, this is going to be a concern for the Federal Reserve. It's also a concern for financial markets. If you've got stronger growth with the potential for higher growth going forward, and we've got inflation that is still very troublesome, the likelihood is that the number of interest rate cuts we're going to see from the Fed in 2025 is going to be reduced. And in fact, that's exactly what's happening. Market pricing has fallen for the number of rate cuts from about 4 originally expected for 2025 to only about 1 today. So this is something we need to keep a very close eye on. So turning to our third point, we are expecting volatility to continue in the financial markets. And this has been a function of that higher growth, stickier inflation, and fewer Fed rate cuts that I've been mentioning. The chart I'm showing you here is 10-year Treasury yields, where you can see all of these factors have contributed to a significantly higher yield environment in the last 3 or 4 months. And this is also having an impact in terms of other financial markets, particularly equities. You can see on the chart here, the bull market that we've been speaking a lot about last year still remains intact. But really since the end of last year, 2024, we've seen some divergences open up. We've seen the equally weighted S&P 500 actually fall below the levels we had prior to the Trump rally. And even the NASDAQ index, which of course is tech heavy and been doing so well, even here we're seeing some signs of this rolling over, as well as the other US indices. Now, we think there's still going to be volatility until we see signs that inflation is not problematic, until the market understands that we expect another 1 or 2 rate cuts by the Fed in the first part of the coming year. I think we need that kind of stabilization in order for this market to build some more momentum and move higher. Ultimately, we think that will happen, but we are expecting volatility to continue for the next few months until we see these proof points that inflation is coming down and further rate cuts are likely. Now remember, as always, you can read the full report on our website, and we look forward again to seeing you next month.